So it looks like a preliminary agreement to raise the debt ceiling happened over this weekend. Now, what are the details that you need to know before the markets start trading on Tuesday? Are stocks going to the moon from here and continuing this ultra bullish rally that we have seen in 2023? Or are things a lot weaker than what the NASDAQ or some of the main indexes would show? And maybe does this have a negative reaction on the stock market? There's a lot we need to get into here in this video. On top of that, some of our favorite stocks, such as Tesla, the retail darling, might actually benefit a lot from this debt ceiling deal. Now, keep this in mind. We don't have any actual details here. What we're hearing so far is that the Fiscal Responsibility Act will block $5 trillion in new taxes proposed by President Biden, claws back billions in unspent COVID funds, eliminates this year's funding for Biden's new army of IRS agents, and fully funds critical programs for seniors, veterans, and America's national security. These things seem positive on face value, but I will tell you this right now. Markets have reacted relatively well considering you have seen the highest inflation in over 40 years. Inflation expectations are going higher, so it looks like inflation is going to be around a lot longer. The Fed has raised interest rates 5% in just over 12 months, leading to an almost certain recession later in this year, maybe 2024, because of government spending. Without this government spending that we have seen over the last couple of years, I firmly believe the markets would be lower than they are today. So if the spending cuts are kind of worse than we're expecting, that's not going to be good. Think about it like this. You went from stimulating the population and putting money in people's bank accounts via stimulus checks, unemployment insurance benefits, and boosts, right? People were getting $600 a week on top of their unemployment insurance already. People were making more sitting at home than working. That fueled a lot of the inflation. That was very stimulative to the general population. It caused a lot of spending. But the government has been doing these stimulus checks for businesses the whole time. They've been spending trillions of dollars, and that has helped really support this economy in ways that are unquantifiable. Now, like I said in the beginning of this video, stocks like Tesla might actually benefit a lot from this debt ceiling deal. And that's because some people and some analysts were starting to speculate that maybe Republicans would try to cut back on some of the green spending that you have seen over the last, call it, 2 years. In the Inflation Reduction Act alone, there was $430 billion set aside for EVs and solar. Some money could have been cut back in this debt limit deal, this debt ceiling deal. And it doesn't look like we're getting news of that so far. So it could come out that maybe there is a reduction to some of the tax credits to EV vehicle buyers or different things, right? 30% of solar is subsidized by the government. Maybe that's a detail that has not been released to us so far. But the initial read on where the spending cuts are taking place doesn't seem negative for Tesla. And I think that it was actually one of the things that held Tesla back a little bit more than some of your other big tech stocks in the last week. Now, let me tell you, big tech has done exceptionally well, really over the last 6 months or so. But specifically in the last 4 weeks alone, the NASDAQ is up about 9.5%. And if we take a look at the chart, this is the QQQ, it roughly follows the NASDAQ. You are now, for the first time on a weekly basis, oversold on the RSI. You have not been oversold on the RSI on a weekly chart since November 19th, 2021. The next day, you peaked at 404.58 and started to fall. And that was basically the high of the market. Essentially, every time you get overbought on the RSI, which overbought is over 70, which you probably can't see right now, but it's down here in the right hand side. Let's go ahead and move this chart a little bit. Now you can see it. Overbought is over 70. You're at 70.82. Every time you have gotten to this level in the past 5 years, you have sold off, and that has been the high of a cycle. 2019 and 2020, you were overbought on the RSI, and then you sharply came down due to COVID. Back here in 2018, you briefly got overbought on the RSI. Markets fell 20% in 2018. Same thing back here in the beginning of 2018. You've seen the first dip that was only like a 7-8% fall. Pretty sizable, but nothing huge in relative terms to what we've seen in the past. But still, RSI oversold, and then the markets fell. And you can see this virtually throughout the history of the NASDAQ. So I think to one degree, the markets have already priced in the debt limit getting raised and a deal getting done. Nobody has really sat here and forecasted a default. At least I haven't seen anyone forecast the government to default. It's never happened in history. It's not gonna happen. At least, hopefully, for a while. That would be a very bad situation overall. So on one hand, the deal looks bullish, but the markets look like they have already priced a lot of that bullishness in. Now, I would say one of the most concerning things that you have seen recently is inflation is actually ramping up again. The Friday data that we got was core PCE month over month. And for the month of April, PCE came in at 0.4%. You were expecting 0.3%, and last month's reading was 0.3%. At a 0.4% month over month annualized basis, that is 4.8%. That is not going to give you a Fed pause, and that is most certainly not going to give you as many as 3 rate cuts in 2023. And most of the market's valuation right now is really unsustainable in a recessionary environment without rate cuts, because if inflation is super high and you don't get a big recession or a moderate recession, you're not going to get rate cuts because inflation's not going to fall that much, especially as inflation expectations have recently went higher. Even the revised inflation estimates that we got on Friday still are coming in at 4.2% on a 1-year annualized basis, and the 5-year inflation expectations are still at 3.1%, going from a low of 2.9%. This is on an upward trajectory, and really the highest the 5-year inflation expectations have been in almost 25 years. So you're not seeing data to support this rally. This rally is really rallying because of AI. And granted, AI earnings have been great. NVIDIA gave you the most absurd guidance that you could have asked for. It was exceptional. If they deliver on their $11 billion of revenue for next quarter, that's insane. NVIDIA is really benefiting from AI. So there is some truth to this rally, but the data just underlying in the economy does not support it. If you take a look at the Fed rate monitor tool for June 14th, you went from a 99% chance of the Fed pausing now to a 64.2% chance of the Fed raising rates in June. So whatever this is at, if it's over 50% for either one, a pause or a rate hike, that's what the Fed's going to do. Now, on top of the very inflationary data that we seen on Friday, durable goods orders also came in at 1.1%. This was better than the estimate of a negative 1.1% reading, but it's down from 3.3% in March. So you're clearly seeing a deceleration in the economy. You also seen personal spending go up much more than expectations. You were expecting 0.3%. It came in at 0.8%. Personal income came in at 0.4%. You were expecting 0.3%. So across the board, inflationary data on Friday. That's what you could really summarize for Friday. And the markets just went higher. The NASDAQ went up like 2% on Friday. This upcoming week, you're going to have more economic data. The JOLTS job openings come in on Wednesday, and you are expecting to see 9.2 million job openings. This would be down from 9.59 million job openings in the month of March. So less job openings, that would be a positive thing for the labor market, for kind of tightening the labor market, and ultimately maybe seeing a pause down the line from the Fed. But the big data is really going to come in on Friday. But you can't forget Thursday, 10 o'clock in the morning, ISM manufacturing PMI for the month of May. You're expecting that to come in at 48, up from 47.1% in the month of April. But Friday's data, you're going to get the unemployment rate. Markets are expecting the unemployment rate to jump from 3.4% to 3.5%. You're also expecting non-farm payrolls to come in at 180,000, down from 253,000 in the month of April. You're also going to get a lot of the second tier data in regards to the labor report, average hourly earnings, government payrolls, average weekly hours, manufacturing payrolls, non-farm payrolls, private. I'm sure by now you guys understand, really the data has not supported this rally. This has been a very hated rally in the markets. It can last for a while though. If we take a look at the NASDAQ's breadth, the breadth of the NASDAQ basically means, are a handful of companies leading the market higher, leading the NASDAQ higher, or are all of them really contributing to a rally? And if we look at the market breadth for the NASDAQ, it is at the lowest levels that you have been at in a very long time. The NASDAQ, like I said, has returned almost 10% in the last month, and the average stock, as you can see from this blue line down here, has done nothing but fall. And the average stock in the Russell 3000 is down below its October 2022 lows. So the markets here have not done well overall unless you're in big tech. Now, I think specifically with this debt ceiling deal, stocks like Tesla will be able to benefit the most. And I think specifically with Tesla, you are not really pricing in the greatest news. I think markets were kind of pricing in some cuts to green energy. If we don't get those, I think that is a big opportunity for a trade and to add some more Tesla to the long term. But as for the broad markets, I'm very cautiously optimistic. I want to be optimistic, but until we see the broad markets participate in a rally and we see inflation trending down again, and maybe the economy getting a little bit better, it's hard to be as bullish as I want to be. So that's my thoughts. That's the latest on the debt ceiling that we know of. Some effects this could have on the markets as well as Tesla. Let me know what you guys think about the debt ceiling and the effect on the markets in the next upcoming weeks down below in the comment section. Thank you guys for watching. Enjoy the rest of your day or night if you're watching this at night, and I will see you in the next one.